Inflation is not a headline event. It is a slow leak. And like all slow leaks, it causes the most damage not because it explodes, but because people fail to notice it until the structure is already weakened. Financial celebrities who built wealth across decades rarely describe inflation as an economic concept. They describe it as an invisible opponent, one that quietly shifts the rules of the game while most players are still celebrating nominal wins. At first glance, inflation appears simple. Prices go up. But this simplicity is deceptive. Inflation is not just about what things cost today versus yesterday. It is about what money can no longer do tomorrow. It erodes certainty. It punishes fixed thinking. And most dangerously, it creates the illusion of progress while quietly reducing purchasing power. This illusion is why inflation is so misunderstood by everyday investors. A portfolio can grow in numbers and still shrink in reality. Financial celebrities learned early that wealth is not measured in dollars earned, but in future options preserved. Inflation attacks those options silently. If money loses value faster than it grows, effort becomes motion without progress. One of the first realizations that separates experienced investors from beginners is that inflation does not hurt everyone equally. It redistributes wealth. It rewards those who control assets that reprice and punishes those who rely on fixed claims. Savers feel safe until they realize their safety is eroding. Borrowers quietly benefit as debts are repaid with cheaper future currency. Inflation is not fair, but it is consistent. Cash, for example, is often seen as stability. It does not fluctuate, it does not scare. But inflation turns cash into a melting asset. Financial celebrities do not hate cash. They respect its role, but they understand its cost. Holding cash without a reason during inflation is not conservative. It is passive surrender. Fixed income suffers a similar fate. Bonds promise certainty, but inflation redefines that promise. A guaranteed payment loses meaning if it buys less every year. Financial celebrities who live through prolonged inflation learn that predictability without adaptability is fragility disguised as discipline. Equities tell a more complex story. Stocks are not automatic inflation hedges. They only protect purchasing power when the underlying businesses can pass rising costs to customers without destroying demand. Inflation exposes weak business models brutally. Companies with no pricing power shrink in real terms even as revenues rise nominally. Quality becomes visible only under pressure. Real assets play a different role. Real estate, infrastructure, energy, and essential commodities exist inside the inflationary system rather than outside it. Their costs rise because replacement costs rise. Their revenues adjust because people cannot opt out of basic needs. Financial celebrities often allocate here not because returns are exciting, but because alignment with reality matters more than theoretical safety. Another underappreciated impact of inflation is psychological. When people expect money to lose value, behavior changes. Saving feels pointless, spending accelerates, risk tolerance rises not because people become braver, but because waiting feels like losing. Financial celebrities anticipate this behavioral shift and position ahead of it. They understand that inflation first moves minds, then markets. Debt is where inflation reveals its most asymmetric power. Fixed-rate debt becomes easier to carry over time. Inflation reduces its real burden. Financial celebrities often structured their balance sheets with this in mind, borrowing long, owning assets that reprice, and letting time work in their favor. What looks dangerous in a low-inflation world can become strategic under sustained inflation. But inflation is not a single condition. It has regimes. Mild inflation lubricates growth. Persistent inflation destabilizes planning. Sudden inflation destroys trust. Financial celebrities do not treat inflation as a binary risk. They analyze duration, source, and adaptability. Is inflation temporary, noise, or structural change? The answer determines whether portfolios survive or merely endure. The most dangerous phase of inflation is the early one, when price increases feel manageable, when adjustments seem unnecessary, when people delay adaptation. Financial celebrities often regret not reacting earlier, not because they missed returns, but because they underestimated persistence. Inflation's damage comes from time, not spikes. Inflation also distorts taxation. Nominal gains are taxed even when real gains are absent. People celebrate profits that barely maintain purchasing power after tax. Financial celebrities account for this drag explicitly. Ignoring it turns apparent success into slow erosion. At a deeper level, inflation exposes mindset. Do you anchor on nominal comfort or real flexibility? Do you value predictability or adaptability? Inflation punishes rigidity and rewards systems that can adjust. Financial celebrities do not try to outguess inflation. They design portfolios and lives that can function even when it lingers longer than expected. History shows inflation rarely ends cleanly. It fades unevenly. Policy responses lag. Markets miss price duration repeatedly. Those waiting for clarity usually receive it after opportunity disappears. The experienced prepare for uncertainty rather than waiting for confirmation. And this is where the story begins to narrow. Because once inflation is understood not as a temporary enemy but as a permanent background force, investment priorities change. Safety is redefined. Growth is questioned. Purchasing power becomes the only metric that matters. It is at this point when investors stop asking how to beat inflation and start asking how to avoid being quietly defeated by it that real understanding begins. Reshaping decisions not in moments of panic, but in everyday choices about what to hold, what to trust, and what assumptions to abandon, as inflation reveals itself not loudly, but persistently, like rust forming beneath a polished surface, invisible until strength is already compromised. And this is where understanding inflation moves from theory into practice, revealing why those who adapt early rarely speak loudly about it, and those who ignore it pay quietly for years. In the second half of this lesson, financial celebrities stop treating inflation as something to predict and start treating it as something to design around. They accept a fundamental reality. Inflation is not a market anomaly. It is a recurring condition of human systems. Governments change, technologies evolve, policies swing. But the long-term bias toward currency dilution has appeared across centuries, continents, and regimes. Once this is accepted, the goal shifts from avoidance to resilience. The first adjustment happens at the level of mindset. Financial celebrities stop thinking in terms of nominal success altogether. They train themselves to see money only as purchasing power across time. A portfolio is no longer judged by how much it grows, but by what kind of life it can sustain 10, 20, 30 years forward. This reframing alone eliminates a vast number of poor decisions driven by illusionary gains. From there, asset selection becomes more intentional. Instead of asking whether an investment will do well, they ask whether it can adapt. Does it produce cash flows that can rise with prices? Does it depend on fixed contracts or flexible pricing? Does demand disappear when consumers feel pressure, or is it embedded in daily life? Inflation punishes rigidity and rewards elasticity. Financial celebrities bias relentlessly toward the latter. Another critical shift lies in balance sheet thinking. Inflation does not just affect assets, it reshapes liabilities. Those who structured long-term fixed-rate debt during inflationary or pre-inflationary periods often found themselves advantaged in hindsight. What looked risky in nominal terms became strategic in real terms. Financial celebrities were careful here, not reckless. Debt was used as a tool, not a gamble, paired with assets that could absorb inflation's pressure. They also learned to respect second-order effects. Inflation changes politics. Politics changes regulation. Regulation changes business economics. Financial celebrities paid attention not just to prices, but to responses. Rent controls, tax changes, interest rate shocks, subsidies. These responses often mattered more than inflation itself. Preparing for the reaction became as important as preparing for the condition. Diversification, too, took on a deeper meaning. It was no longer about owning many assets, but about owning different inflation responses. Some assets benefit from inflation spikes, others protect against policy backlash, others preserve value when growth slows. Financial celebrities built portfolios that could bend without breaking across multiple inflation scenarios, not just one forecast. Another subtle but powerful adaptation involved lifestyle discipline. Inflation tempts lifestyle inflation. Rising nominal income invites rising commitments. Financial celebrities resisted this aggressively. They understood that fixed lifestyles paired with variable currencies create long-term stress. Flexibility in spending became as valuable as flexibility in investing. The less your life costs to run, the less inflation can threaten your freedom. Over time, inflation also reshaped how they viewed risk. Cash felt safe, but dangerous in excess. Growth felt exciting, but fragile without pricing power. Stability felt comforting, but illusory if fixed. Risk was no longer volatility, it was loss of adaptability. Anything that could not adjust became suspect, no matter how calm it appeared on the surface. The most experienced investors also learned patience with imperfection. Inflation hedges rarely work cleanly. They lag, they overshoot, they frustrate. Financial celebrities accepted this messiness as the price of protection. They did not abandon strategy because results were uneven in the short term. They judged effectiveness across cycles, not quarters. And perhaps the most important lesson is this: inflation exposes who is planning for the world as it was and who is planning for the world as it changes. Those anchored to past stability feel betrayed. Those designed for adjustment feel vindicated not because they predicted correctly, but because they assumed uncertainty was permanent. So the story resolves into a quiet but demanding truth. Inflation does not destroy wealth suddenly. It dissolves it slowly, invisibly, and impersonally. The winners are rarely those who chase the perfect hedge. They are those who restructured thinking, portfolios, and lifestyles so inflation could no longer erode them unnoticed. If this reflection resonated with you, pause and ask yourself one question. Are your investments built to preserve numbers or to preserve freedom in a changing world? The answer matters more than any inflation forecast. Share your thoughts. And if you want to keep learning how to think clearly about money in an environment designed to confuse, stay connected. Subscribe, follow, and return. Because inflation will always be present, but ignorance of it does not have to be.